So, how on earth did a struggling video game store end up at the center of a financial earthquake that cost Wall Street titans literally billions of dollars? Well, the answer is a short squeeze, one of the most explosive and fascinating events in the entire market. In this explainer, we're going to dissect this whole phenomenon, from the meme-fueled chaos of GameStop all the way to the high-tech data wars that are shaping its future. Okay, let's get into it. So here's our game plan. We'll kick things off with the GameStop saga, because that's what really brought this topic into the spotlight. Then, we're going to break down the nuts and bolts of how these things actually work. After that, we'll take a look back at some famous historical squeezes, dive into a really surprising academic finding, and finally, check out how technology is changing the game for good. All right, let's set the scene. It's January 2021, and a story unfolds that honestly feels like it was ripped straight from a Hollywood script. You've got a ragtag band of online traders taking on the absolute giants of Wall Street. This is the story of GameStop, and it's just the perfect way to understand the sheer chaos a short squeeze can unleash. So you gotta ask, how did a brick-and-mortar retailer, a store many people saw as a total relic in an age of digital downloads, manage to just completely turn the financial world upside down? The answer is this potent cocktail of social media teamwork and a very, very risky bet made by some of Wall Street's biggest names who were convinced the company was doomed. And wow, this chart just says it all. I mean, just look at that spike. It's practically a vertical line. Now, this wasn't because of some hot new product or a sudden jump in profits. Nope. This was triggered almost entirely by users on the subreddit r/Wall Street Bets. They spotted a huge vulnerability, coordinated their attack, and honestly changed the conversation about the power of the small-time retail investor forever. And here is the absolutely critical number. The reason this was even possible. At one point, about 140% of GameStop's publicly traded shares had been sold short. Now, you're probably thinking, wait, how can you short more shares than actually exist? Well, it's because the same share can be borrowed, sold, and then borrowed by someone else, creating this massive, teetering pile of bets against a company and setting the perfect trap for a squeeze. Okay, so that 140% figure, that was basically the gasoline poured all over the floor. But to really understand how the fire started, we need to look at the match itself, the concept of short selling. Okay, stick with me here. Imagine your friend owns a rare comic book that you think is way overhyped. You borrow it and promise to give it back in a month. You then immediately sell that comic for, say, $100. A week later, a terrible movie based on the comic comes out, and its value just tanks. You buy it back for only $20, return it to your friend, and boom, you've just pocketed $80. In a nutshell, that's short selling. So here's the process, step by step. You borrow, you sell, you wait for the price to drop, and then you buy it back. Sounds simple, right? But here's the catch. What happens if you're wrong? What if the price doesn't fall? Unlike buying a stock, where the most you can lose is what you paid, with short selling, your risk is, well, it's theoretically infinite. There's no limit to how high a stock price can go. And this is where the squeeze finally comes in. It's that moment when a short seller's very calculated bet goes horribly, catastrophically wrong. Some unexpected event happens. Could be good news, a buyout offer, or yeah, even a coordinated buying frenzy on social media, and the stock starts going up instead of down. This kicks off what some people call a doom loop. As the price climbs, brokers start making margin calls, basically telling the short sellers they need to deposit more money or close their positions now. And to close their position, they have to buy the stock. But that very act of buying just adds more fuel to the fire, pushing the price even higher, which forces more short sellers to buy, and on it goes. It's a brutal cascade effect that creates those insane price charts we saw with GameStop. You know, GameStop might have been fueled by memes and Reddit, but the short squeeze itself is a classic market play. It's got a history that stretches back more than 100 years. The technology definitely changes, but the playbook, it stays remarkably the same. Just take a look at this. All the way back in 1901, a battle between actual titans, JP Morgan and E.H. Harriman, over a railway accidentally cornered the market and sparked a squeeze so bad it caused a panic on the New York Stock Exchange. Then, fast forward to 2008, Porsche tried to take over Volkswagen, which sent VW's stock up over 400% in 2 days, briefly making it the most valuable company on Earth. They called that one the Infinity Squeeze. And then, of course, you have the Reddit rebellion of 2021. We're talking 3 different centuries, 3 totally different reasons, but the exact same painful outcome for short sellers. So we've seen how good news or a bunch of people buying at once can set off a squeeze. But what if I told you that sometimes the absolute worst news for a company can be the best news for its stock price? It sounds completely backwards, I know, but some recent research has uncovered this really fascinating twist. I mean, it just doesn't make sense, right? Short sellers will often publish these big negative reports laying out all the reasons they think a company is a bad bet. They release this bad news, hoping it'll drive the stock price down. But what if that exact move could backfire on them spectacularly? Well, a 2021 study looked at hundreds of these short attacks. And you can see here about 70% of the time it works just like they want. The stock price drops. But in a wild 30% of cases, the price actually goes up. So why does this happen? Because when they publicly announce their big short position, it's like sending up a flare. It alerts other traders that a stock is vulnerable to a squeeze. So they jump in, start buying, and try to intentionally trigger that doom loop we talked about. And this just powerfully shows you the risks involved. That same study figured that when one of these weird, counterintuitive squeezes happens, the average loss for the short-selling firm is a staggering $70 million. It really shows you just how high the stakes are in this game. So this all brings us to right now, to the modern era. Because this cat and mouse game between short sellers and everyone else is being completely transformed by technology, data, and of course, social media. Let's take a look. For decades, the whole world of short selling was kind of murky, hard to see into. But now, you have data providers like Market who are just pulling back the curtain, offering this almost real-time view into all the bets being made against companies. It's a fire hose of data that's giving traders the ammo they need to spot the next potential squeeze. And here's the key difference. The old traditional data from the exchanges is slow. It only comes out twice a month. That's like trying to navigate a hurricane using a weather map from 2 weeks ago. But the modern indicators, they're based on the actual transactions of borrowing and lending shares, so it's happening almost in real time. It can show you not just how many shares are shorting, but also the price they were shorted at, so you can see exactly who's losing money and who's under the most pressure to buy back. And you can't talk about this without mentioning social media. This famous tweet from Elon Musk basically taunting Tesla short sellers, it just perfectly captures this new reality. These battles aren't being fought in quiet Wall Street boardrooms anymore. They're public spectacles, playing out in real time for millions of people to watch. So it all boils down to this. With regular people coordinating on platforms like Reddit, with high-speed data that can expose a company's weak spots in seconds, and with CEOs who can rally millions of supporters with a single tweet, has the fundamental power balance in the market shifted for good? That's the huge question that traders, regulators, and all of us are trying to figure out right now. The world of short selling is a high-stakes, high-risk game of cat and mouse. And with social media and real-time data now in the mix, that game is just getting faster and way more complicated. It's a fascinating story, for sure. But please remember, this explainer is just for educational purposes. This is not financial advice.